Hello, traders! Welcome to the Sensei Traders Academy, your trusted guide in mastering the art of price action and smart trading decisions. As you know, we typically place our trades at key levels on the chart, buying in zones where demand is strong and selling where supply dominates. These are the areas where market participants tend to agree. Buyers step in with conviction, sellers retreat, and the price often reverses or accelerates accordingly. But here's the thing, what happens when those levels aren't truly solid? When they look decent on paper but lack real market conviction, trading on such weak foundations can quickly turn into a roller coaster ride of false signals and painful losses. That's why it's not just about finding levels, it's about identifying the right ones, the ones that carry weight, meaning, and repeatable behavior over time. In today's episode, we're diving deep into one of the most powerful and underutilized tools in technical analysis, order blocks. These are not your average support resistance levels, they're high impact footprints left behind by institutional players during major moves. Think of them as market fingerprints, evidence of large scale buying or selling activity that has shaped the current trend. We'll walk you through exactly how to spot order blocks on any chart, how to draw them correctly, and most importantly, the four non-negotiable rules that make an order block reliable and actionable. Whether you're new to this concept or looking to refine your approach, this breakdown will help you build confidence and consistency in your trade setups. So let's begin with the basics. What exactly is an order block? An order block is essentially a concentrated area where significant market participants, like central banks, hedge funds, or big institutional traders, have placed large orders, often over multiple candlesticks. This creates a sudden shift in the balance between buyers and sellers, resulting in a sharp directional move. You'll notice these zones often appear after a period of hesitation or consolidation, followed by a decisive breakout. The key idea here is imbalance. Unlike regular zones, order blocks emerge from a clear dominance of one side, either buyers overwhelming sellers in a bullish context, or sellers overpowering buyers in a bearish one. And because this imbalance is so pronounced, it leaves a visible mark on the chart, one that tends to hold up well when price returns later. That brings us to the second big reason why order blocks matter, their retest behavior. When price revisits an established order block, especially after a strong move, it frequently reacts in a predictable way, either reversing sharply or continuing its trend with renewed strength. This makes them incredibly valuable for both entry and exit strategies. Let's take a closer look at this example to really understand how candlestick structure can reveal hidden market dynamics. If I only draw the body of the candles, ignoring the wicks or shadows, we still see that powerful upward move, same direction, same energy. The price is clearly pushing higher with conviction. But here's where things get interesting. When we add in the shadows, the story changes dramatically. In the first scenario, imagine price surging all the way up to a certain level, then suddenly pausing and pulling back just a bit, say to a specific zone where traders had been waiting for a retracement. That's where the real action happens. All those pending orders, buyers ready to step in if price dipped, or sellers preparing to take profit, get triggered right there. So if we label that pullback point as an order block and assume it will act as a strong support or resistance again, well, that's usually where things go sideways. Why? Because the market has already cleared out most of the existing orders during that initial move. There's no fresh supply or demand left to create a meaningful reversal, just empty space waiting for new participants. Now contrast that with the second case. Suppose someone was watching closely, waiting for a pullback to enter long. If they missed that first wave, they'd have been left behind entirely. The price moved too fast, and by the time it pulled back, the opportunity was gone. But now on the way down, attention shifts. Traders start scanning for a new entry point, and that's exactly where the second order block forms. This one represents a fresh area of interest where buyers are still gathering and the market hasn't fully absorbed the pressure yet. That's what we call inefficiency, a gap in market absorption where the current price level hasn't been fully tested before, giving room for new momentum to build. So let's wrap this up with the final rule. It's actually quite simple once you've got the idea. The order block must be unmitigated. That means no prior reaction. Think of it like a blank canvas. Once price has already bounced off or broken through a zone before, it loses its original power. We want clean, untouched areas, places where buyers or sellers are truly waiting without any previous activity clouding the picture. It's not about how many times something happened, but whether it's happening for the first time. And that's the key to spotting high probability setups. That's it for today, traders. Thanks so much for tuning in. You're making each session better by being here. If you enjoyed this breakdown, hit that like button, subscribe to stay updated on more strategies, and drop a comment below if you've got questions or want to share your own observations. We're always happy to help you refine your edge. See you in the next episode. Keep trading smart and keep looking deeper.